the economic recovery. Welcome to the Valuation Masterclass case study, where you're going to learn about interesting stocks and how to value them. What's interesting about Terex is that it trades at a 50% discount on both PE and price to book to the U.S. industrial sector. This is Andrew Stotts of the Valuation Masterclass. Let's get started. Before we do, remember this is for information purposes only and learning. This is not investment advice or a recommendation. Terex is a company in the U.S. industrial sector. It's among the world's largest manufacturers of aerial work platforms and materials processing machines. And the question is Terex the right industrial sector stock to own to ride the economic recovery? There's three things you should know about this company. First, heavy government spending on infrastructure drives top-line growth. Second is cost cuts to drive sustainably higher margins. And third, strong ROE and ROIC might be overlooked by the market. Some key statistics: there's 16 analysts covering the company, and they've got it as a buy, 39% upside, and a $59 price. The PE ratio is 12 times, and dividend yield is 0.6. My value estimate is about $48. That's about a 14% upside. So it still is a buy, but I'm being a little bit more conservative. Let's look at the sales of the company. Elevation platforms account for 40% of sales. And we can also see material processing accounts for 25%, and specialty equipment 16%, and others at 19%. The breakdown by region is 57% sold into North America, where they started, and Western Europe 20%, and Asia Pacific 17%. Now, for those of you that know, I grew up in Ohio, and the little town that I grew up in Ohio called Hudson, Ohio, had a huge Terex plant. And the Terex plant closed down when I was leaving Ohio in about 1985. And now, of course, they've right-sized the business over the years. Oh, Amon Rot, thank you. You said handsome, so kind. All right, now let's go through and look at it in a little bit more detail. First of all, it's been sideways movement for the share price. Right now, throughout the past year, the stock price has mainly moved sideways. So I would say not a lot of great signals happening in both volume and also in moving averages. So not a lot to get excited about, but still there's upside. It's a matter of whether it can catch a catalyst to move. Now, number one part of the story is heavy government spending on infrastructure drives top line growth. Now here is a chart showing U.S. federal infrastructure spending, and it's in the 100 billion plus. Most of Terex customers are dependent on government funding for infrastructure projects like highways, as an example. The government has increased its spending by over 50% in 2020 and 2021 compared to prior years. The heightened level of spending is likely to stay over the next few years, providing good growth opportunities for the industrial sector. The chart that I'm showing here shows that infrastructure spending was stuck at about 100 billion US dollars for many years. And then in 2020 and 2021, it shot up to about $160 billion. Now, near-term strength is already being seen in the backlog. I'm now showing a chart of Terex's backlog, and it's pretty massive in September of 2021. At that time, Terex's backlog stood at $2.7 billion, which is double the average backlog of the prior years. So it's pretty massive what they got. Therefore, I expect strong revenue growth in the upcoming years. And also, let's look at point number two in our story, that cost cuts to drive sustainably higher margins. This chart that I'm looking at right now is showing the SG&A and EBIT of Terex. And we can see the SG&A falling over time and EBIT slowly rising. So let's talk about that. Terex continues its efforts to reduce its costs and drive its margins closer to the level of competitors. Therefore, management considered divestment of inefficient businesses as one option. In 2019, Terex sold its crane business, and the efforts are starting to pay off as operating profits achieves a higher level. As we can see here, operating profits are just getting close to 500 million US dollars. And I see some more room for improvement here. Now, let's talk about point number 3. Strong ROE and ROIC might be overlooked by the market. I've got a chart here looking at ROIC, WACC, and ROE. And what we can see from this is that the ROIC is the red line, and it's been climbing, and it's up to 20% as of 2021. That's a phenomenal return. And I think it could go up even higher in 2022. In fact, it was really mainly 2020 where it went below the cost of capital. The company needs to prove itself to maintain such a heightened level of profitability. 20% ROIC is pretty massive when you consider my estimate of their cost of capital is about maybe 10 to 10.5%. If the company is able to do so, it could be a key catalyst for re-rating. And right now, the company's pretty cheap. Given the strong demand outlook, I believe that the market should be more optimistic about the profit growth. Remember, you can scan this QR code to go to valuationmasterclass.com blog to download all free, full case study reports. You can do that, and this one will be up very soon. If you are watching or listening, you can also go to the show notes and click the link. Let's review the company's FVMR scorecard. It measures a stock's attractiveness relative to all other companies. Attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. The scale is 1 best to 10 worst. Here we can see that generally it's done pretty well. It looks pretty well in the scorecard, except risk. And let's look at fundamentals a bit. And what we can see here is fundamentals are pretty strong. What we can see is operating profit margin is at about 8%. The highest it had in 2018 was 9. So it's getting close to coming back to where it's been. And asset turnover is starting to improve. We're at 123 in revenue per assets, and hopefully they can continue to drive that. They previously had it at 130. Last thing I would just highlight is that the net margin at about 6.6% is pretty good. I would say if they can maintain this, they'll be in good shape. So let's continue on and look at the next part, which we'll talk recently about FVMR. So recently I created a short online course explaining my FVMR investing approach, and I usually sell it for $97, but for a limited time, I'm offering it for free. Just scan the QR code or go to the link in the show notes. Now, here's the forecast. There's 16 analysts covering the company. Again, they're optimistic, 39% upside. The majority have issued a buy recommendation, while 6 analysts recommend a hold. Consensus expects strong revenue prospects and a rising margin, which we can see in the table, which I'm showing you there. And considering the growth, the growing infrastructure spending, I think the company could realize its targets. Let's review a couple of things in the P&L. The company is likely to turn around its loss, which it had a loss in 2020, a loss of only $11 million. And what we can see is that that should turn around 2021 to 227. That's based upon what we've seen so far this year. And then 2022, we should be able to get to 286. Let's look at the asset side of the balance sheet. And the key thing to look at here is significant increases in inventory and receivables as sales volume is likely to ramp up, as shown by that strong backlog. So they've got to have some working capital funding to support that. Let's look at liabilities for a moment and try to understand what's going on there. The key thing is the company started to reduce its long-term debt over the years, and it's now come down to about 872. With interest rates rising, it's best to really lock in the shortest cost debt that you can get right now. Now, in third quarter of 21, its net debt to equity stood at about 0.3 compared to 0.6 in 2020. So a pretty significant improvement. Let's look at a couple ratios. The first one I want to look at again is to highlight the revenue per asset. The company is characterized by a strong efficiency, which is also boosting equity, return on equity. And that's coming up to what I'm expecting to be 136 asset turnover, meaning 136 revenue for every 100 in assets. So if we look at the next levels of margins, we can see gross profit margin has come back up to about 20.5%. And with increased focus on most profitable products, Terex could return to a gross margin of 20% and stay above it for a while. There is room to improve. Now, if you're looking for a career in finance, that's a funny picture of me. And if you're looking for that career in finance, that was me on a Bloomberg thing, I think, then you should check out my 6-week Valuation Masterclass online that starts on March 7th. By the end of the boot camp, you're going to have gained real experience from writing a professional research report. You'll have learned the exact skills to help you become a leading analyst, and you'll come closer to interview for your dream job. You can save $402 until February 28th. Just go to valuationmasterclass.com/bootcamp. Let's continue on. And the valuation of this company we can see is, first, let's go through the checklist to try to understand it. This is inspired by Peter Lynch's 10 baggers that came out of his book, One Up on Wall Street. And it's based upon our extensive research of 10 baggers. And there's 9 factors that we found drove long-term performance. The first factor is management, that management has a proven commitment to growth. Here, I would say the potential is weak. Revenue steadily declined between 2015 and 2020, and management focus is on profitability, seems like now. The next is growth, and the product and industry can support a decade of 10% annual growth. This is moderate. Industry is cyclical and likely to grow roughly in line with global GDP. So I would say kind of unlikely. So already 2 of them show we probably don't have a 10-bagger here. Number 3 is sustainable. Competitive strategy creates sustainably high gross margin. Weak. Competition is intense, and existing players are challenged by low-cost manufacturers in China. Number 4, quality. Good earnings quality, and core items are small or non-existent. This is weak. There's high fluctuations. Net profit has been negative in 2016 and 2020. Number 5 is efficiency. In the long run, sales grow faster than assets. This is good. The company is characterized by a high level of efficiency. Asset turnover is about 120, meaning 120 in revenue for every 100 in assets. Tight, relatively low cash conversion cycle. Negative is best. Moderate cash conversion cycle is relatively high at about 70 days. And cash flow, operating cash flow is consistently positive. This is number 7. Moderate operating cash flows have fluctuated a lot, but have been able to cover investing outflows. Number 8, capacity. The company has access to capital to fund growth. Here, I would say good. The company continued to reduce its debt. Net debt to equity is down to about 0.3. So very, very low. And finally, number 9, the question is, can this company become a 10-bagger? And we're looking for stocks that are inexpensive. And what we can find is pretty good. It trades cheaply on PE and price to book compared to U.S. industrials, and ROE is about in line. From all of this information, can this company be a 10-bagger? Well, I'm not that convinced that it can be. There's just not enough goods here. Now, before I continue on, I see a message or a question from Peter. And he says, do you have a link for the Valuation Masterclass? That's an excellent question. Do I have that link? I don't have that link here, but you can scan the QR code, and I'll put the link down below. Once this video is done, you'll see the link there. So let's look at the free cash flow for the company right now. It's been consistently positive, and there's no reason to assume differently. It's making about $250 million in free cash flow. And the forecast assumptions I've made is about 5.8 on the revenue forecast, and a little bit rising net margin up to 6.6. So similar to consensus, I expect strong revenue growth and some margin improvement. And Terex is likely to ride the demand wave induced by government infrastructure spending. The company's highly cyclical, reflected in the above average beta of about 1.25. Now, I'm going to show you the value based upon the free cash flow to the firm methodology, and the cost of equity I'm using is 13.8, and the terminal growth is about 3. So what do we get? We get a base case of a 14% upside, a bull case of 27% upside, and a bear case of 3% upside. Let's look at the world-class benchmarking scorecard on this company. Remember that the scorecard helps us to identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth. And we use a score from 1 best to 10 worst. Here we can see that there's been a massive turnaround for the company. In the past 12 months, it ranks in the top decile when it's benchmarked against 1,400 large industrial companies worldwide. Well done. What's driving it? Well, improved profitability. Profitability is ranked as a 3, so significantly above average, and growth is ranked at a 1. Wow, their EPS growth really is bouncing back. Let's talk about the risks. Well, first of all, thinking of the risks, I would say that the key risk is intensified price competition, and low-cost competitors from China could result in a loss of customers, and its customers are dependent on government spending. And dependency on suppliers can lead to volatile margins. So they are impacted by the economic recovery as well as supply chains. So the conclusions are the ramp up of government infrastructure spending makes it worthwhile to look at industrial companies. Terex has room to expand its margin, making it a profitable growth play. So valuation is relatively cheap, trading at about a 50% discount. So my question to you is Terex the right industrial sector stock to own to ride the economic recovery? What do you think? Let me know in the show notes below and in the comment section below. Have a great